To Cyrll Shroff, a managing partner of law firm Amarchand Mangaldas. Cyrll, thank you so much for joining us on ET Insight. Let me start by asking you, what's your first reaction to the takeover? In terms of direction, are we headed the right way?
Yes, I think it's certainly a big change. When directionally, I think it's fine.
But the rider on 100% open offer that all outstanding shares need to be acquired, that's going to be very controversial. A lot of companies are unhappy. They're saying it's going to increase their cost of acquisition. What's your take on that as a legal expert?
Undoubtedly, because the size of the offer goes up, there will be a greater need for financing, and finding those resources is going to be a challenge. But I've always believed that if the value exists in the target, the acquirer will somehow find the money or find a structure to make it work.
There's also some lack of clarity on control. So is that going to be an issue that's going to bother companies in this M&A game?
If I were to prioritize 2 or 3 main areas where I'd like to see more clarity, control is one of them. So it's actually been made even more ambiguous than it already was by insertion of the word ability to control as also constituting a trigger regardless of the number of shares that are acquired. Now, what the word ability means and how it is going to be interpreted, is it going to be a course of conduct, is it going to be a status of rights and contracts or behavior, that's all still up in the air. And I would really hope that as the code is finalized in the coming weeks, that there is some more clarity on this.
Right.
Granted that control is one of the most difficult areas worldwide to define. Nobody has yet been able to form a perfect definition of it. But at the same time, we shouldn't have gone in such an ambiguous direction. So that's something which I hope will get sorted out. Otherwise, it will make practical implementation of transactions very difficult.
Right. Now, going back to this whole issue of open offer for all outstanding shares, are there any related regulations that we need to change to facilitate this to actually happen? Are there any regulations in banking or FDI that need to be changed?
A couple of things. So if cash has to be used as consideration for acquiring 100% shares, firstly, finance has to be available from the banking system. Currently, the only avenue for such products of such financing would probably be the NBFC sector, and that would have its own constraints. There are currently capital market exposure limits on the banking sector, and if that avenue is dried up, realistically an Indian acquirer would find it extremely difficult to put up the money. Now, the other option, of course, is to look for non-cash consideration, which could be shares or debentures or other securities which could be given. This was always allowed, even under the old code, but the imperative is even greater now. And for that to practically work, there needs to be cognate changes to be made, such as the FDI policy which you mentioned, or the ICDR regulations, where if a preferential allotment of securities is made by the acquirer, the terms and conditions under which that could be done, whether there would be a lock-in on them or not, what would be the floor price. So all of these factors would need to be streamlined in the context of shares being used as consideration for this. And unless all those changes are made, non-cash offers would be impractical.
And a lot of companies are also upset that the fee that we're paying for non-compete, that again will now be calculated for the retail shareholder offer as well. So is that a good thing or a bad thing? Because obviously it means that it's reducing the flexibility or the premium that a company is willing to pay to keep the companies buying off the management from coming back as competitor.
There's a moral dilemma over there. And the committee could, I think, have gone either way. They could have sustained the non-compete fee as was always there, or abolished the distinction between controlling and non-controlling shareholders. Again, you must remember that non-compete was really a proxy for control premium. It was not really non-compete in a contractual sense. It was just another way of defining control premium. So in my view, whilst there is something to be said about having that extra charge by way of a control premium or non-compete, the better view in a developing market, and as we're getting more sophisticated, is to treat all shareholders equally.
So to sum it up, would you say that some of the concerns that industry has are perhaps a little overblown, given that we are now moving in the right direction?
This is a big game changer. There are concerns about the size of the offer, which once there are a couple of transactions which are done and non-cash consideration as a means of payment becomes more the norm, which is pretty much the norm in other markets. I think corporate India will get comfortable with it.
Well, that's all on this edition of ET Insight. We'll be back next week. Until then, don't forget to write in with your feedback and suggestions. Thanks so much for watching.